What does CFD mean? CFD trading stands for Contract for Difference Trading. It is a form of derivatives trading that allows traders to speculate on the price movements of financial instruments without actually owning the underlying asset. Instead, traders enter into a contract with a broker to exchange the difference in the price of an asset, such as a stock, commodity, currency, or index, from the time the contract is entered into to the time it is closed. CFDs offer traders the ability to trade in both rising and falling markets, and to use leverage to amplify their returns. However, CFDs also come with greater risks, as the use of leverage can lead to large losses as well as gains. CFD trading, pros and cons. Contract for Difference, CFD, trading is a popular form of derivatives trading that allows traders to speculate on the price movements of financial instruments without actually owning the underlying asset. CFDs offer traders the ability to trade in both rising and falling markets, and to use leverage to amplify their returns. However, as with any trading strategy, it's essential to understand the pros and cons of CFD trading before getting started. Pros of CFD trading. Flexibility. CFD trading offers a high degree of flexibility, allowing traders to go long or short on a wide range of assets, such as stocks, commodities, currencies, and indices. This means that traders can profit from both rising and falling markets, providing more opportunities to make money. Leverage. CFD trading also allows traders to use leverage, which means that they can trade with a larger amount of capital than they have available in their trading account. This can amplify potential returns, but also amplifies potential losses. Low costs. CFDs typically have lower costs than traditional forms of trading, such as stock trading. This is because CFDs do not require the purchase of the underlying asset, and the only cost is the spread, the difference between the bid and ask price. Cons of CFD trading. Risk. CFD trading carries a high degree of risk, as the use of leverage can lead to large losses as well as gains. Traders must be aware of the risks and have a clear risk management strategy in place. Complexity. CFD trading can be complex, and it's essential to have a good understanding of the underlying asset and the market conditions before getting started. Traders should always ensure that they fully understand the terms and conditions of the contract before entering into a trade. Volatility. The markets in which CFDs are traded can be highly volatile, and prices can fluctuate rapidly. This means that traders must be prepared for sudden price movements and have a strategy in place to manage risk. In conclusion, CFD trading can be a valuable tool for traders looking for flexibility and the potential for high returns. However, it's essential to be aware of the risks and to have a clear risk management strategy in place. It's also important to fully understand the underlying asset and the market conditions before getting started. Traders should always do their research and be prepared for the volatility of the markets. Thanks for watching, and please subscribe for more money-making ideas.